What's up guys, Sterling the Investor here. Happy New Year. And in today's video, we're going to talk about the stock market and the bearish condition that it's in right now. So let's jump right into it. Alright guys, so let's jump right into it. I'm going vintage old school. I've got my notes right here. So I hope you guys don't mind. I'm going to refer to them sometimes. But basically, let's start off by saying this, that no one can accurately predict the market. So, a lot of people are saying, oh, I should have gotten out of stocks before they started crashing, or I'm going to wait for the bottom to start buying. And the truth is that it's impossible to time those events. The best thing to do is just to stay in the market. Now, you can change, what stocks you invest in, what types, what sectors, your total allocation from your portfolio, from what you want to have in cash or what you want to have in stocks. However, it's impossible to time it, so you just have to be in the market. The thing is, most people don't want to deal with the temporary pain, the downside of a bear market. But in reality, when you think about the history of the stock market, every bear market is followed by a bull. And to put it in perspective, bull markets typically last longer than bear markets, and you typically gain 2 to 3 times as much as you lose in a bull market than what you do in a bear market. Alright guys, so I'm going to throw a quick fact at you. So take the 10 best days in the stock market over the period of about 20 years, from 1998 to 2017. And you take the 10 best days in the stock market. If you pull those out because you tried to time the market perfectly, because you tried to be out when prices were low, to sell when prices were high, and realize profits that way, if you try to do all of these things and you happen to miss out on the 10 best days in the stock market over that period, you would have cut your returns in half. The market averaged a return of about 7.5% to 8% over that time frame. If you would have missed the 10 best days, it would have cut your returns in half to about 3.5% to 4%, just because you weren't patient, just because you tried to outsmart the market. Nobody in the history of mankind has been able to accurately predict perfect times to get in and out of the market. And I think I'm pretty intelligent. I'm sure you're pretty intelligent. But if no one has done it over the history of mankind, I don't think either you or myself are going to figure it out. So the key there is just to be in the market. Don't be afraid of the bear market. You should actually embrace it. Like I mentioned earlier, if you gotta allocate your funds a little bit differently, but don't get completely out just because of the bearish market. The great Warren Buffett, the best investor of all time, has a saying, be greedy when others are fearful, and be fearful when others are greedy. So that's exactly what you should do. Speaking of what you should do, there's no safe way to go about a bear market. I'll just put that out there. Nothing is safe. I mean, I wouldn't even consider the stock market period safe, even in a bull market. But especially in a bear market, there's nothing safe that you can do. However, here's a few options of things that you could do to, give your chance a better chance of success during the bear market, and maybe make it a little bit easier for you to stomach the pain that comes with the bear market. So the first thing that I'll mention is something that I hit on a little bit earlier, which is allocation. So, some people's investment profiles say, every month, with their discretionary money, they put 50% into savings and cash and 50% into the stock market. So, that's an even allocation, but during the bear market, if you can't really handle seeing those losses, those temporary losses, you may want to move to a 40-60. You put 40% in the stock market and 60% in savings, or a 25-75, a 25 into savings and cash, and 75 into savings and cash, and then 25 into the stock market. You can weight your allocation differently according to what you're able to stomach. Me personally, I'm a little bit more aggressive. I'll keep mine around 50-50, because it doesn't bother me to see the temporary losses, to feel that temporary pain in the market, because I know my end goal is long term, so that doesn't really bother me too much. The next thing you could do, is the type of stocks you invest in. So you definitely want to stay around blue chip stocks. Your Dow Jones Industrial 30 stocks, your S&P 500 stocks, stocks that pay dividends, because then that dividend can offset some of the losses that come with the bear market. So that's something you can do. Invest in stocks, in companies that are a necessity. So, consumer goods, utilities. You want to stay away from luxury products. Like, you don't want to get into stocks involved with like luxury cars or, things that people don't need, because in a bear market, if the economy follows and people stop spending money, they're not going to spend money on luxuries, but they will spend it on necessities. So your money will probably be a little bit more stable in a stock that's associated with a necessity. The next thing would be investment grade bonds. You're not going to get crazy returns here. Probably a little bit better than a savings account. However, it's one of the more safe options for you to look at. ETFs and mutual funds globally. So just because our economy and our stock market may be suffering doesn't mean that's happening everywhere. So that's something else you may want to look at. And something that I'll mention that I personally don't do, it's not really my thing, but gold. During the last recession, or historically throughout history, through recessions, gold has held its value better than the stock market. So that's something else that you may want to, allocate some of your funds to. If that's something that you research and you feel confident about. Again, it's not something that I do, but I just wanted to put it out there for you guys. So I hope you guys enjoyed this video. Don't forget to like, subscribe, comment with any questions that you have, and I'll catch you guys in the next video.